Today, I'm going to walk you through the most fundamental valuation analysis called the DCF to equip you with the knowledge you need to value stocks. What's up everybody, my name is Ben and welcome to Rare Liquid, a channel for tech investing and career advice. Today's agenda looks like this. First, I'll provide a conceptual overview of the DCF. I'll then talk about why DCFs are important and when to use them. Then I'll go over how to do a DCF and 4 key concepts. And lastly, I'll show you a DCF using Tesla as an example. Just to let you know in advance, this is not going to lead to a buy or sell decision for Tesla using a DCF. That's not really the purpose of this video. The video is more to educate people on how to do a DCF. And so sorry if that's what you came for, but that's not hopefully what you're staying for. The DCF is not really a hard analysis, but it is something that has a lot of parts to it that will take some time to explain. So this is going to be part 1 of a many part series for the DCF, and you can check a playlist on my channel called DCF videos and for all the videos in the future that will be related to DCF valuation analysis. If you've been a loyal follower to this channel, first of all, thank you. And you probably have been realizing that I've been branching out into a ton of different topics like investment banking, crypto, stocks, and I keep everything organized as playlists on my channel. So if you ever want to dive deep into a certain topic, check out the playlists on my channel. I'll leave a link to it also in my description below. Lastly, in case you are new here, all of the things I'm about to tell you come from my experience from working as an investment banking analyst at JP Morgan for a few years. So that's where all of the knowledge will be really coming from. And the experience and instruction and training that I received from banking is what I'll be using to kind of teach you guys about DCF. All right, with that said, let me go over the conceptual explanation of a DCF. Just in advance to let you know, I'm going to be using a lot of words for the next 10-15 minutes or so to explain what a DCF is. And then towards the end of the video, you're going to see a lot of numbers associated with a lot of the concepts that I provide you. So make sure to stick through the whole video and try not to skip around if you have the time because everything is going to connect well together. Let's first start off with something like a textbook definition. A discounted cash flow analysis is a valuation methodology that measures the intrinsic value of a company based on the present value of its future free cash flows. If this is all new to you, this probably all sounds like nonsense. So let's break down the 3 important concepts in this definition. First, intrinsic value. This just simply refers to a company's true standalone value based on its ability to generate cash rather than comparing it to other assets. Intrinsic valuation compares to relative valuation, which I made a video about if you want to check that out. But basically, relative valuation is when you compare one company to another set of companies to obtain valuation information, while intrinsic valuation is you're only looking at that one company, creating a model, looking at the financials in order to get to a valuation. Just to really hammer this point home, let's use a bicycle as an analogy. Let's say that you have a bike and you're trying to figure out what the value of it is. Relative valuation is where you would get the bike and compare it to other similar bikes at a bike store, see what those bikes are selling at, and then you can get a good sense of what your bike should sell at. Now, let's say you're getting this bike not for fun, but only for work, and you're trying to see what is the value of what I should pay to make sure that it's worth really buying this bike. And so let's say you're using it for Postmates only, and you realize that over the next few years, you can use the bicycle to earn something like $1,000 in cash. And so you wouldn't want to spend anything above $1,000 because basically then you would kind of lose money. But if you were spending, let's say $500 for the bike, then that would be worth it because you'd be able to profit $500 over the next few years. So that's really kind of the core of intrinsic valuation, really just looking at a company, how much cash can it generate, and after I do my model, is the value of the company that I can currently buy it for, or the stock I can currently buy, is that lower than what it's trading at? And if so, then it'd be a purchase. If not, then you would not want to buy it or sell the stock. Second, let's talk about present value. And this really just refers to the concept that $1 today is worth more than $1 tomorrow. I think thinking about this concept actually is more helpful with larger numbers. So let's say that someone offered you $1 million today versus $1 million 50 years from now, and you had those 2 options. Which one would you take? Besides the fact that you probably just want $1 million right now instead of when you're a lot older, the fact is that you can use that $1 million today and starting tomorrow, just put it into the market and earn a return over time. And so that's basically why $1 today is worth more than $1 tomorrow. Just to crystallize this a little more, let's say you invest that $1 million into the stock market for 50 years and get a 1% or 5% or 10% annual return. And you can see that the values in the future are much, much greater. Tying this all to the DCF, basically what we're saying is that you can't just calculate a company's future cash flows and then say, oh, that is the value of your company. You have to get those cash flows and discount it back to the present value, or AKA today's value. Third, there's the concept of future free cash flow, and basically this refers to the fact that a company's value is based on the cash it's able to generate from today until the end of time. Okay, so let's think about what this means. If you think back to our bike analogy, you remember that the bicycle's value was the ability of it to be able to generate cash until the end of time. And that's true for any single company that you're trying to buy, whether it's a lemonade stand or a restaurant on the corner or Nike or Tesla. The ability for these companies to generate cash, that's really the value of the company. Tying all of this together, let's go back to our definition just as a reminder. A DCF is a valuation methodology that measures the intrinsic value of a company based on the present value of its future free cash flows. Okay, so now that you understand the concepts behind the DCF, let's next talk about why it's important and when to use it. First, focusing on why the DCF is important. Really, there's no other better way to find the intrinsic value of a company other than this method. But you don't have to just take my word for it. Every investor from Warren Buffett to Bill Ackman has stated in the past that a company's value is the sum of its future cash flows discounted back to present value. Okay, but with that said, a DCF can't be used for every single type of company, or at least it's not suitable for all companies. And so let's talk a little bit about why that is. There are a lot of companies out there that just are cash flow negative and will be for the next, 5, who knows, maybe even 10 years. And so for something like that, you can't really create a model where you're projecting out future free cash flows, because then basically you're going to get to a negative number, which means that someone has to pay you to buy the company, which of course just doesn't make sense. As a result, a super ideal candidate for a DCF would be a company that's been around for decades, like let's say General Electric, that doesn't really change its business model too often versus something like a tiny little startup. So doing a DCF analysis is kind of like a double-edged sword, because you're able to cater your entire analysis to what you believe, but at the same time, you better believe those assumptions are going to be correct, because everything is really based on those assumptions and if they're right or wrong. But just to be clear, you technically can create a DCF for any type of company, no matter how unpredictable it is. And for example, back at my time at JP Morgan, when I was covering healthcare companies, I was creating DCFs for biotech companies that didn't even have drugs yet out on the market and wouldn't for the next few years, and was projecting out cash flows for 20 to 30 years. And basically, we were just trying to see, if we believed in certain assumptions, what would this biotech company be worth? Let's next talk about how to do a DCF and the 4 key concepts. The first step is to project out future free cash flows, usually out 5 to 10 years. You then calculate the terminal value using either the exit multiple or perpetuity growth method. Third, you discount the free cash flow and terminal value back to present value using your WACC. And lastly, you sum everything up to get your enterprise value, which is the value of your company. Now I'm going to show you this entire process with the Tesla DCF, but there are 4 concepts that I mentioned here that I want to just dive a little bit more into the details and the formulas to really make sure that you understand these concepts, because they're super fundamental to the entire DCF analysis. The first one is free cash flow, and this is your EBIT times 1 minus your tax rate plus depreciation and amortization minus capital expenditures minus your change in net working capital. This is the formula for what's known as unlevered free cash flow, and you can think of this as free cash flow available to all owners of a company, including both equity and debt holders. You can also calculate what's known as your levered free cash flow by subtracting out interest expense and mandatory debt repayments, but don't worry about that. Just focus on unlevered free cash flow for your DCF, because that's really the best practice kind of for a DCF. Only focus on unlevered free cash flow. Got that? Unlevered free cash flow. And to explain the formula a bit more, your EBIT stands for earnings before interest and taxes, and is basically your revenue minus cost of goods sold minus your operating expenses. From here, you subtract out taxes and incorporate 3 common predictable cash flow items, which are your D&A, CapEx, and net working capital. Going into each of these different topics is gonna kind of take a lot of time. So basically what I'll do is define each of them. And in the comments down below, I'll have a comment pinned where I define everything. So Make sure to check that out if you haven't really heard of what these concepts mean. The second core concept is terminal value, and this essentially is the value of your company from your last projected year until the end of time. Now, you can find this terminal value either through what's known as the exit multiple method or perpetuity growth method, but I'm gonna only focus on the perpetuity growth method because at least at JPM, that's the only thing I use, and I personally think it's the best way to calculate your terminal value. For the perpetuity growth method, the formula you use to calculate terminal value is your last projected cash flow figure times 1 plus your terminal growth rate, all divided by your WACC minus your terminal growth rate. I know this formula might look super confusing, but basically all it's doing is growing your company's cash flow until the end of time at a really steady rate. The third concept is terminal growth rate, and this just represents a steady state at which your company will grow until the end of time. Most of the time, this rate is around 2 to 3%, which basically is the rate at which the US economy grows. The theory behind this is basically if you think of the entire United States as one really large company, basically obviously no company is going to grow larger than the United States. And so if you think the US economy can grow 2 to 3%, then any company from now until the end of time, they're probably not going to grow any larger than 2 to 3% as they keep growing, because as you get larger, it's harder to grow faster. The fourth concept is probably the most confusing, and that is your weighted average cost of capital, also known as your WACC. Now, you probably remember me saying multiple times throughout the video that you need to discount back your future cash flows to present value, and basically the rate that you use to discount back is your WACC. The formula you need to know for WACC is your percentage of equity times cost of equity plus your percentage of debt times cost of debt times 1 minus the tax rate. Going into this also would probably be a video on its own, so basically I'll leave more about it in the comment below that I'll pin down. Basically though, what you need to know is that 10% is an average WACC, while riskier companies go from around 11% to 15%, while more stable companies go from around 6% to 9%. You can go lower or higher than this range, but typically you'll see WACC in this range of about 6% to 15%. Okay, so now that you have all the concepts down, let's go into the Tesla DCF. First of all, I want to really preface everything by saying that this is a really simple DCF just for illustrative purposes, and I just want to show beginners kind of what it really looks like. And so this is not in any way financial advice of me saying what Tesla stock is worth. In my next video, I'll be building on top of everything we discussed today and doing a more advanced DCF. So if you haven't already, and if you're interested, click that subscribe button. And while I have your attention, please also smash that like button because it would really help support the channel. Okay, now let's go through the Tesla DCF with the 4 steps I previously laid out in the video. First up is projecting out free cash flow, and for Tesla, I've projected it out for 10 years. This really is the crux of the entire DCF because mostly everything else is formulaic, but this is where most of the really important assumptions come into play. The first thing you'll want to do is get the past 3 to 5 years of historical figures, basically so you can see how the company has been performing. As a quick pro tip, I like to go onto bamsec.com and download the tables and import them into my model and link to them directly so that I know my numbers are 100% accurate. Going back to our model, I'm not actually going to talk about how I got all these numbers and assumptions because they're probably all wrong. I just kind of inputted random numbers and I just really wanted to show you what a DCF looks like. So as you can see here, I projected out revenue for 10 years, then calculated EBIT as a percentage of revenue, subtracted out taxes, added back depreciation and amortization, subtracted capital expenditures, and subtracted change in net working capital, all to get to our unlevered free cash flow, which you can see here. Step 2 is to calculate the terminal value, and so right here I used our perpetuity growth rate formula, which as a reminder is our last year's free cash flow times 1 plus the terminal growth rate, all divided by our WACC minus the terminal growth rate, and this gets us to a terminal value of $876,322 million. Step 3 is to discount the cash flow and terminal value back to present value using our WACC, which we do by grabbing our cash flow and dividing it by 1 plus your WACC to the power of each respective year. And for the terminal value, discounting it from the furthest year out we've projected, so year 10. Step 4 is to sum up the present value of the cash flow and terminal value to get to our enterprise value of about $440,651 million. And if you want to get to our implied share price, then we would want to add cash, subtract debt to get to our equity value, and divide by our shares to get to our share price, which as you can see here is $463.93, which is much below Tesla's last closing price of $625. So based on the current assumptions I have in the DCF, it's telling me that I probably don't want to buy Tesla stock, but let me show you how changing a few assumptions can drastically change everything in the model. Initially, we got to a share price of about $464, but if we want to change our WACC to 10% and 2030 growth rate to 12%, you can see that our share price jumps to $732.83, which implies that we may want to buy Tesla. So as you can see, the DCF is an incredibly flexible tool that you can use. But of course, it also can be a little bit unreliable or iffy because you just really have to make sure that you think your assumptions are correct. And if you think about trying to project out anything from 1 to 5 years, no matter what it is, like who's gonna win a certain baseball game or a basketball game in the playoffs or something like that, it's so hard to predict who's gonna enter the playoffs or something like that, right? And so if you think about entire companies, how massive they are, how quickly industries change, all the assumptions you put into a DCF are almost 100% going to be wrong. And so basically the DCF is just one tool that you use to kind of use as a gut check to see, okay, is this company undervalued or overvalued based on what I put here in the model? And is the price too crazy right now? Do I have to believe in insane revenue growth numbers or really, really high EBITDA margins in order for me to think that the company's stock price deserves to be at a certain level? That's really what the DCF is for. And you want to incorporate it with other kind of like qualitative information, like what the management team is going to do over the next few years, or what they say they're going to do, who they are, how quickly the industry is growing, what additional products you might see in the pipeline. That's all the stuff you want to be looking at as well as your DCF. All right, guys, props to you if you made it throughout this entire video, because you're on your way to becoming a better and smarter investor. I've been getting a lot of requests of these kind of how-to videos, and so please leave me a comment down below if you found this helpful and interesting. And also please help out the channel by clicking the like button, subscribing, and turning on post notifications if you'd like. One reason why you might want to turn on those notifications is because, as I said in previous videos, I award $10 to the first person who comments and also a random commenter. So here are our winners for today. If that is you, just DM me on Instagram to collect your winnings. And the last thing I want to mention is that you can get some free money by looking in the description below and seeing the different exchanges that are offering some rewards right now. So you can, for instance, on Coinbase, deposit some money and get $10 free in Bitcoin. You can get free stocks from signing up on Webull and Moomoo. So check those out if you want some free money by signing up for those exchanges. All right, that concludes the video. Thank you so much as always for watching. Please feel free to tune in for the next video coming out in a few days. Thanks as always. Peace out.